right, class, we're going to look at the next section now. That's investments. Okay, if your corporation or business has investments, this is how we handle them. And it's a little bit tricky, so you got to be very careful. It doesn't necessarily make a lot of sense how do we categorize them, which I'll explain in a little bit. You just kind of have to remember the rules and learn the rules. And once you learn those rules, it's not too difficult. It's just each category is handled in a different manner. Now, first of all, our investments, we can invest in debt securities or equity securities. Debt securities would be such things as notes, bonds, which we talked about previously in a previous video, bonds payable. In our case, this would be a bond that we own, so it would be an asset. This would be a note that we own, so a note that we're going to get money on in the future, or maybe CDs. So we're going to pay for these things, we're going to buy these things, and then later we'll get that money back, plus interest over the life of the note or the bond or the CD. With equity, this is when we're purchasing stock. We're purchasing ownership in a company. And with this, we'd be paying cash for this, and we'd get the stock, so it would be an investment. And then over the life, we won't get the money back unless we sell the stock, because it doesn't mature. Debt securities typically mature. All these items do mature. Equity securities aren't going to mature, but you will be receiving dividends periodically. Instead of interest, you receive dividends periodically. Now, how do we account for debt securities and equity securities? How do we account for these things? Well, you can see I've got 5 different categories here. The first one is trading. Hold on, I've got to grab my pen here. We could have trading securities. Now, these are debt or equity. So either debt or equity securities can be trading securities. We categorize these. Well, first of all, we intend to hold these and manage for a profit. So we intend to hold and manage for a profit. We're going to categorize them as current assets because we're planning on trading them. We're trying to make some money quick usually, okay? So we're planning on holding them and hopefully the value is going to go up, okay? So that's why we intend to hold and manage for a profit. They're going to be categorized as current assets. We record them at cost, but we adjust to reflect fair value, okay? So we record these at cost, but then at the end of the period, if they've gone up in value, if the total portfolio has gone up in value, then we will adjust to that fair market increase, okay? And that fair market increase will go in other income, or if it's a loss, losses, okay? So other gains or losses is where that be found, all right? So once again, with trading securities, we record them at cost, but then we adjust them to their fair market value, and that increase, that adjustment, will go into either a gain or a loss, okay? So it goes on your income statement. This adjustment goes on your income statement. Now, held to maturity are debt. The only possibility for this category is debt, okay? And if we're gonna hold it, the only one that has maturity are debt. Equity goes on forever, these stocks, right? As long as the company keeps going. Debt securities, these have maturity dates, so that's why held to maturity, HTM, would be debt. Let's see, we intend to be able to hold to maturity, so intend to hold to maturity, just like the name says. This can be recorded as either short-term or long-term, okay? So if we're planning on holding it for a year or less, about a year, it's going to be short-term. Anything over a year, we would categorize as long-term. We record these at cost as well. Now, there's no adjustment for these though, okay? This we adjust for fair market value. This we do not adjust, okay? However, it's reported at its amortized cost. I just want to point this out. It is reported at its amortized cost, and that's beyond this class, okay? That's more of an advanced level accounting, but you just need to know at this point that this is recorded at cost and no adjustment is made for fair market value, okay? Unlike this one where we do adjust for fair market value and that adjustment goes into the gains or losses section of the income statement. All right. Our next category is available for sale or debt. Available for sale, and it can be either debt or equity. And basically the definition for this is that it's not a trading or held to maturity, I'm going to abbreviate here, HTM. It's not a trading or held to maturity security, all right? So it's not a debt or equity security that's trading or HTM, then it would be categorized as available for sale. These are recorded at cost, and we do adjust, oh, hold on. This can be long-term or short-term. Okay, it can be long-term or short-term depending on how long we're going to be holding it. This is recorded at cost, like I just said, and then we do adjust to fair market value. So we adjust, I'm going to write this down, adjust to fair value, and the adjustment is going to go into the equity section. It's going to go in the equity section. Okay, this one over here, we adjust to fair value, and the adjustment goes on the income statement. I'm running out of space here. I'm just going to abbreviate income statement. Okay, sorry, it's kind of hard to write down that low. So this one we adjust to fair value on the income statement. This one are adjustments to fair value, but it's the equity section of the balance sheet is where we're going to adjust it. And then this one we don't adjust. All three we originally record at cost, and then these two we adjust. The trading and the available for sale get adjusted. Held to maturity doesn't. It's recorded at cost. And there's going to be videos that are going to explain, going to show the transactions for trading, held to maturity, and available for sale. So you can look for those videos too. Just a reminder that on my channel, you can see playlist for my videos. So if you're trying to find a video, you can always go to my channel and look at the playlist, and you can see a list of my videos there. Okay, if you can't find them. Okay, so trading, held to maturity, available for sale. There will be videos explaining how we actually do those journal entries. Now the last two I'm just going to go over really quickly. We've got significant influence and controlling influence. They're both equity securities only, not debt securities, because it deals with ownership in the company. It deals with stock. So this first one, it's going to be long-term. So we put that down here. Long-term. Both are long-term. We record these at long-term. Recorded at cost. Both are recorded at cost. This is 20. If you have 20 to 50% ownership of the stock, then you have what we call significant influence. Okay? If you own 20 to 50% of the ownership in the stock of this company, you have a significant influence. It's an equity security. We're going to record it at long term. And there's special ways to account for this. All right? Controlling influence is also equity. It's when you have over 50% ownership in voting stock. Over 50% ownership in voting stock. It's long term also. And this is when we consolidate this. So we've got the parent. The parent would be the controlling interest, and then the companies that they basically own are the subsidiaries. Okay? So now this chapter is a little bit confusing, like I said at the beginning. You got to keep going through these because there's really, I mean, it makes sense that we've got trading, held to maturity, and available for sale, but how we actually handle them is very different. Okay? You kind of got to memorize and learn the ways that we handle them. All right? So once again, there will be videos on these categories also, so go and look at those to see how we handle them and what the journal entries are. All right? Thank you, class.